So the market is currently selling off, with big tech, SPACs and growth stocks taking the biggest hit. For example, we've got Tesla down 15% on the week and 30% for the month. NEO down 25% on the week and 40% from its high last month. Household names like Amazon are also down 5.5% on the week. Apple also took a small hit. The Nasdaq itself down around 2%. And the recent flourish of SPACs are coming under the most pressure, it seems, with the likes of Opendoor being down 20% in one day, although a lot of this was to do with the results they published, not just the sell-off. IPOE or SoFi down 21% as well as the likes of ACTC, which is going to be Proterra, which I'm a big fan of, also down 26% on the day. So huge sell-offs. I expect some of you will know how sell-offs are caused or started. It only usually takes a small catalyst in a fragile market such as the one we're in right now. So firstly, let's start with inflation risk. Stimulus has been somewhat extreme over the past year, with trillions of dollars being pumped into the global economy, more specifically though, the US economy. And what happens in this event is investors get worried that the Fed will raise interest rates to push back against inflation. Nobody knows exactly when this will happen, but usually people listen out for the Fed. Fed Chair Jerome Powell came out this week and actually said interest rates are going to be kept low, or at least not going to be hiked, even though there may be some inflation in the near term, but it will not be enough for the Fed to hike rates. The Fed are more interested in creating a financially stable environment, equaling good news for equities. So why has the market been selling off? The main catalyst is we have bond rates rising. And let's take the 10-year Treasury as an example. So since February, the yield has gone from 1.2% to 1.5%, which is around a 20% rise. Why does this matter? Well, it's because this is technically risk-free money to investors. If they hand over the money to the US government, they're guaranteed a 1.5% yield for 10 years. This risk-free rate is what the majority of investors use to calculate the present value of money in the future, among other methods as well, but this is one of the main factors put into it. Therefore, when it is very low, equity prices spike because the underlying assets in equities achieve much higher returns on capital than the 1% bond, but generally it's because there is a lack of places to find a return other than stocks. And you might ask, why are bond rates rising if the Fed isn't actually raising interest rates, or at least committed to it? Well, you can think of bonds as the inverse to stocks in the way that they trade. What happens is when demand is high for bonds and people are buying, the price gets bid down, or the yield, gets bid down, making the asset technically more expensive and less valuable. If you've got a 1% yield instead of a 2% yield, that 1% yield is much less valuable and technically more expensive than the 2%. So the opposite happens when nobody is wanting to buy bonds. The price or yield gets bid up, therefore causing the interest rates on the bond to look more attractive, so people buy them. And people aren't looking to buy bonds at the current rates because inflation estimates are way over what the current yields are, especially on a 10-year basis, so therefore locking investors into a loss when measured on a real return basis when they buy bonds. So to summarize all of this, the risk-free rate rising means that stocks technically look less cheap when using the risk-free alternatives as a measurement. And the reason why they're rising is because of inflation concerns. Now, you might think it's only gone from 1.2 to 1.5% recently, and that's true. But since the low in December of less than 0.9%, and then even lower than that going back into 2020, it's traveled up quite quickly. And as you all know, the stock market is a forward-looking mechanism where all the players are trying their best to guess the future. So what you can take from all this is the market believes inflation will happen, and therefore bond rates on the risk-free rate will rise, therefore reducing the demand and the price of stocks today. And does all this really matter? It does, but not really. Firstly, as we've covered on this channel already, the market is going to go through cycles like this where macro factors affect the market valuations, and investors get bearish on the near-term future of stocks, or stock groups in this case. And we can hardly argue with prices being near all-time highs when measured in relativity to their earnings and the economy in general. The intelligent investor will flip this situation on its head and turn it into a positive for them, which is what I've been doing. So now we've got that intro and explanation over with, Here's two big tech stocks, or two out of favor stocks that you should potentially buy the dip on. I already have. Now, there's good reason why big tech has been out of favor the past couple of weeks. Valuations are high. They've run up for a very long time. Even in respect of interest rates, they're high. And the law of large numbers says that not all of these companies can grow to compensate the valuations, although some will. Now, you might think you don't want to own mega cap tech and you want to have growth exposure through only small cap or sub $25-50 billion companies that have higher growth potential. And that's fine. You'll probably do fine off of that, but you have to be ready for the volatility and to wake up with your portfolio, say 30% down on any given day. You could also look at value plays, which I do when the time is right. In my opinion, a lot of those worthy of picking up for that reason were left in 2020. Now, these mega cap or tech names that have a lot of growth left in them at least provide a lot of certainty in terms of what their performance could be over the next 3 to 5 years. They're definitely not going to go away. A lot of these names are so ingrained in people's lives. So it's just a case of being able to estimate the return, seeing which ones are the best picks, seeing which ones have growth left in them, if any. I already own both of these companies in Alibaba and Facebook, but increased my positions on Friday. And here's just a quick thesis based off the numbers, more for demonstrating why these are more clear picks than the others. When measured against their peers, they are by far the most attractive in terms of value. For example, here's a list of the 10 largest stocks by market cap, and the majority of them are classified as big tech due to the nature of their business, apart from maybe Berkshire. And I've screened all 10 of these companies on their current valuations. And as you can see, apart from Berkshire, two of the standouts are Facebook and Alibaba with a 25 times PE, which is cheap in comparison to an Apple, Microsoft, or Google even. And one of my favorite metrics to check is the free cash flow yield, and because it can be measured against maybe a bond yield or a more safe haven yield. Obviously, it's not as safe as a bond for obvious reasons, but we can measure it against that and see how high it is compared to what the alternatives are out there. And as you can see, Alibaba presents the best free cash flow yield of the lot, with Facebook not being too far behind. And actually, Facebook's earnings yield is very high as well. It's just that they spend quite a lot on capex that brings that free cash flow down. Now, this only tells us so much, so they could well be cheap for a reason. So let's look at the expected growth rate, which is going to be the fundamental driver of the stock for the next 3 to 5 years. Okay, so the expected rates aren't as high as a Tesla or Amazon in terms of earnings growth, but that's more because those businesses are only just getting to profitability, whereas Facebook and Alibaba have constantly proved that they can be profitable, and they've been profitable for years now, with proven high rates of return to match that as well. And if we combine the two metrics to get an ultimate indicator of value, in this case we're going to look at a PEG ratio, we can see that Facebook and Alibaba win by a clear landslide. Berkshire actually appears as cheap, if not a bit cheaper, but a lot of those earnings are paper earnings through the equities that they own, so you have to consider that. Of course, there's more to it than just a PEG ratio or looking at current valuations. We have to factor in the future of the business, but we'll get to that. And also, these are only two companies out of a possible 10 that I've screened, but they are two of my favorite in general. Hopefully, this gives you an idea, though, of how you can screen stocks in a market like this, as the prices are dropping rapidly, and you can get an idea of which price you maybe are looking to pick up a stock or any stock in a given group, or which stock maybe presents the most upside out of a given group. And it's also a good way to screen industries. If you have a theme or secular trend that you feel is a big winner in the next few years, then you can use something like this to analyze the most suitable picks. But again, remember, you need to factor in various other characteristics before buying. Suggest that you'd stick to good companies. Don't go betting on a company that you don't have a high conviction about their future. The company itself will carry more power than the valuation alone, especially if you're looking to hold it over a long time. And what I also like about these two right now, if I go into a little bit more detail, is they're down out of favor due to external factors that haven't actually had any profound effect on the operating business results. And this isn't to say that they won't in due time, but I think it's currently overblown. And they're both still in their earlier stages of development and growth when compared to most of their peers, especially Alibaba. If we just pick on them for a moment, it has a growing economy behind it that's going to be powerful, with segments of the business such as maybe cloud that are yet to contribute profit but will do so in due course, and they're also growing at 50-60% per year. Meaning we have twin engines of top line growth, which is expected, and an earnings expansion. Facebook, on the other hand, is a growth machine with returns on capital that are best in class. They actually reached 86 billion of revenue in 2020, with 33% profit, and the announcement was pretty much neglected. There's concerns about Facebook's rivalry with Apple in relation to ad changes, and Apple being in control of the iOS software had arisen, as well as the Australian news situation, and in general Facebook just pissing a lot of people off. But that's Facebook, and this is more of a distraction than a worry for me at the moment. The situation could progress further, but it's unlikely in my eyes. To sum it all up, I'm more focused on the operating businesses of these companies for now, with growth expectations in the region of 20 to 25% over the next 5 years. I feel with the current valuations, that's probably too good to ignore. And that's all for this video, guys. Just a quick update on what I've bought on this dip. I have actually bought more. I just wanted to get something out on maybe some of the bigger tech names that I've bought on this dip, and hopefully an understandable explanation of what's been going on and what's driving this market downturn. Be careful out there, guys. Good luck with all of your investments, and I will see you in the next video.